just excited for this topic because leading the planning team, I guess I get the unique perspective to see what our members are asking our planners about on a regular basis. And not only over the last few months, but probably beyond that, we've been getting a ton of questions about crypto. So we've been trying to offer more education, more opportunities to really kind of demystify crypto and ultimately, help all of you as you're, looking at the SoFi platform, making decisions, make those educated and informed decisions. So really, I'll just moderate today, leverage the expertise of Brian Brooks, who is the CEO of Binance US. And kind of go from there. I guess quick disclosures before we get started. Nothing we talk about today should be looked at as financial advice. Think about it as high level education, guidance, really thought starters. Certainly crypto is not going to be appropriate for everyone. It's about your risk tolerance, about your objectives, your time horizon. And, quite frankly, you need to make that decision on your own. But as we go through this, hopefully some good ideas as you're weighing that decision. I guess, Brian, first of all, thanks for joining us today.
Thanks, Brian. Thanks for having me.
Yeah. And, I think this is great because now it's easy to remember your name because it's the same name as me. So super simple. But I guess before we get started and kind of diving into the talking points, why don't you just kind of give the viewers a little bit, high level about your background and your journey into crypto?
Well, Brian, I really appreciate it. And thanks everybody for joining. Paige tells me we have like almost record signups for today, which tells me a lot more about crypto than it tells me about Brian, either you or me. But I'm glad to have the audience for this situation. Look, I'll tell you a little bit about how I came to the topic, but I'll just tell you the reason probably that anybody knows my name is that I spent the last year or so, up until about 6 months ago, in a government role called the controller of the currency. So my job was that I ran the office of the controller of the currency in the federal government. And what that meant was that I was in charge of the national banking system, which historically you think of as a pretty staid, traditional area of finance. But a lot of the work that I did at the OCC had to do with the way that the future is going on network, and the idea that networks are coming for banks the same way they used to come for department stores, before Amazon, or the way that they came for information in the days when people still used post offices. And so what I tried to do running the national banking system was to envision a future where networks change everything. And that's what crypto is all about, as we'll discuss today. It's all about the networks that power a future financial system that isn't controlled by a small number of large banks. And I know Brian will get into a lot of that. In terms of my background, it's sort of funny the way I came to this because, of course, I grew up in traditional banking. I was a banking lawyer for a long time at a big law firm. And then when the financial crisis came, I had a couple of sort of fascinating opportunities. This just goes to show that out of crisis does come opportunity. One of them was I had, the biggest celebrity client that I'd ever had in former Fed Chairman Alan Greenspan, who asked me to represent him before the Financial Crisis Inquiry Commission. And I learned a lot about the financial crisis from the person that some people accuse of having created the financial crisis. But that was a fascinating experience, which then led me to the second really interesting experience I had, which was being invited by a guy named Stephen Mnuchin, who 10 years later became the Secretary of the Treasury, to be part of an investor group that took over some of the most important failed banks in the financial crisis, and to run those banks under the brand name of One West Bank in Southern California. That was the experience, Brian, that really showed me how broken the traditional financial system is, how reliant on outdated technology we are, how much a lot of our credit assessments are just guesswork, how brittle banks are in terms of the investments that they're allowed to hold. It just showed me lots of things that might even be unfixable in the traditional banking system. So that led me down an interesting path. So I ran that bank for a few years. We sold the bank in 2015. And I went on to the next role as general counsel of Fannie Mae, the big mortgage investor back in Washington. And it was at Fannie Mae when I really saw how bad big finance could be. Fannie Mae is a really important company run by a bunch of really smart people, but it's so big that it can't respond to anything going on in the marketplace. It really is like trying to turn the Titanic. Something that large takes a really long runway before you can make even a modest course correction. And that's when I discovered fintech, the idea that, hey, there are automated processes, there are APIs, there are softwares that can make the system run a little bit better. You could improve the mortgage speed of approval by 30 or 40% if you use technology versus manual underwriting. You could make appraisals 15% more accurate if you use satellite imaging, those kinds of things. And so that to me seemed like an amazing thing. You could make the system a little bit better. Who wouldn't want to do that? And that's when I discovered crypto. Crypto is not about making the system a little bit better. Crypto is about replacing the system, right? It's about getting rid of the single points of failure that have governed the financial sector of the economy for 1,000 years, and replacing it with technology that gets rid of intermediaries and allows people to transact peer-to-peer in much the same way that email basically replaced the post office. Remember the days when we all wrote letters and you needed a big central repository to collect up all of the letters and put them in the right bags so they could be put on the right trucks to go to the right towns. And that took a really long time and cost money. And then one day technology arose and said, you don't ever have to do that again, right? You can just send an email directly from Brian to Paige, and that's the deal. That's what I believe is coming for finance. And I think the evidence over the last 3 or 4 years as crypto prices have risen and as network adoption has grown, I think all that proves me right. So a lot of meaty things to talk about today about how these networks work, about why crypto tokens have value and the like, but it couldn't be a better time to have this conversation, Brian.
Yeah, and I appreciate that. And I think that transitions really well into kind of thinking about where to start, because a lot of times, when we're kind of prepping for this, we get asked about, crypto as a currency, but it's much more than that. And, you shared some interesting thoughts on really, I guess, kind of the myths and demystifying, crypto. So I guess, can you kind of touch on that and some of the problems that crypto would be, helping to solve in a more broad way?
Absolutely. So in a minute, I'm going to put up a couple of slides that I think will make this a little bit easier to understand. But before we do that, let me just say the biggest impediment to understanding what crypto is the name. Okay, that's the biggest problem to understanding it. Somebody once upon a time came up with this word cryptocurrency, which leads people to believe that these things are like currency. They're things you can spend at the Starbucks to buy your coffee or whatever. And if you think about it like that, then you're likely to think, well, then cryptocurrency is just not very effective because Starbucks doesn't seem to take Bitcoin in the morning. And even if they did take Bitcoin, geez, I'm going to have to realize capital gains and pay taxes when I sell $5 of Bitcoin to buy my coffee. Why in the world would I want to do that, right? But it turns out that nomenclature is really a misnomer. These things are not, in the main, intended to function as currencies. There are a handful of tokens that do, and we'll come to that. But that's not really what it's about. What it's really about, as I like to say, is crypto is not about disrupting money. That's what the name would imply, is we're here to disrupt money. Crypto is about disrupting banks. That's what it's about. The idea is to bring network effects to banking the same way that we used to bring network effects to commerce. So if you remember the old department stores that used to exist, they've all gone bankrupt because of Amazon, right? Amazon was what networked retail looks like. And again, I make the post office point. Email is what networked mail looks like. So the question is, what does networked finance look like? And the answer is you have to run on a decentralized network for that to work. You have to get rid of the rails that banks own and create a decentralized network that we own. And so now, Paige, if you just put up the first slide, I'll sort of explain what I'm talking about. Okay, so let's go to the next slide. We might have put these sort of in a backwards order, but I think it's the second slide I want to start with. Yeah, so this slide right here. So what I want to tell you in the first instance is cryptocurrencies more or less fall into two basic categories. Okay, and the metaphor you should have in mind as I describe these two categories is, think about your cell phone, okay? Your cell phone's connected to the internet. It's a smartphone and it's got internet connectivity through cellular or Wi-Fi technology. And the internet, right, means that your phone is at all times connected to a network of servers that are out there managed by Google and a few other big companies. And the network is the power of your phone. On top of the network, though, sit a whole bunch of apps. Right? See all those apps, and you have a bunch of apps on your phone as well. So there are two things going on with your phone. There's the internet layer, and then there are the apps on your phone that sit on top of the internet. So whenever you're logging onto Expedia or the United app or whatever it is that you're using, those are running on an underlying thing called a network protocol. And those are the two things that make the current internet valuable to us. I'm going to suggest that crypto is doing the same thing with one important exception, and that's what this slide will illustrate. So what crypto is trying to do is it's trying to get away from the model of a centralized internet, the servers of which are controlled by a handful of big companies, principally Google, okay? And it's trying to build a decentralized network that can do the work that the central authorities finance currently do. So like in the internet, Google is the most important player, and there's Facebook and a couple of others that own a lot of power, Amazon. In the world of finance, the thing that's doing the powerful activity is the bank, right? It's the bank that validates how much you owe on your loan. It's the bank that validates how much you have on deposit. It's the bank that clears your check or your Venmo payment or whatever. So just as in the world of information and commerce, over here in finance, there's a big central intermediary, and it's controlled by a small number of big companies. Really, the four biggest banks control the payment system and the lending markets and almost everything else in finance. So the idea is we need to get away from that and build a decentralized network that you and I control. But how can we do that? You and I don't own server farms, and most of us on this call probably aren't billionaires. And so there's no incentive for us to go invest in server farms to control an internet. So what we have to do is figure out a way to get people who don't know each other, like the 150 people on this call and Brian and me and Paige and all of our neighbors, to connect our computers and our cell phones to do the work that a bank would normally do. Why would we do that, right? We're not getting paid to do that. Well, in the world of crypto, the reason that you would log on and join this new internet, the reason that you'd tell your computer to start running software that is validating transactions much like a bank would, is because you can get paid. The way you get paid in the world of this new network of finance is you receive a crypto token every time your computer successfully does the work of validating a transaction. So if we think about Bitcoin, which was the original crypto token, Bitcoin was the proof of concept that said, actually, a bunch of random people will be willing to download the Bitcoin software, which, by the way, you can just Google on the internet and download today. They'll download the software, and their computer will start running that software in the background. And what the software is doing is validating all of the transactions going across the Bitcoin network over a period of time. And every 10 minutes, one of those computers is the lucky winner. It successfully validates the transaction that all the other computers agree with. And when it does that, it gets a Bitcoin. In the early days, there were very few computers connected to this network, and so Bitcoin wasn't very valuable, right? It was super easy to be the winning computer because there might have only been 20 computers. But over time, as people realized that this thing was super fast and powerful and private and everything else, more and more people started connecting their computers to the Bitcoin software and doing the work of building this network. That's why Bitcoin today is worth $40,000 versus, on inception, it was worth a fraction of a penny. It's worth $40,000 because it's gained adoption. So the value of Bitcoin, and I'll say more about this in a second, the value of Bitcoin is determined by some of the same things that give Google stock value. Google stock goes up when there's more internet traffic, right? Because Google is the main portal most people use to access the internet, and certainly the main portal that most people use to do search on the internet. So as traffic goes up, Google stock goes up because people are using it more and more eyeballs are looking at the ads that run on it. Same thing with Bitcoin and all of these tokens that sit at this yellow layer here that we're calling the consensus layer. These are tokens that induce you to connect your computer to maintain a network. And there are a whole bunch of these tokens. They're all doing the same basic work. So whether you're talking about the Bitcoin token, the Ethereum token, which is called Ether, the Solana token that I mentioned here, these are all what we call layer one tokens or protocol layer tokens that are the reason people are willing to devote power to maintaining networks. That's easy to understand. Again, it's like the network that powers your phone. On top of that internet, just like in the real internet, is another layer of tokens, and these are the application layer tokens. Much like you have the internet, but you also have Expedia on your phone. And so in the world of crypto, there are lots of tokens that are applications sitting on top of the network. And these are all doing very specific things for you. So some of these are, for example, decentralized lending platforms. Some are decentralized exchange platforms, sort of like if you want to think of a crypto version of Charles Schwab, they sit there. Some of these are loyalty tokens that allow you to participate in your favorite store's loyalty program, but also trade that loyalty program for other assets by making it a fungible token on a platform. So all you need to know in the first instance, Brian, is that tokens fall into one of two categories, generally speaking. There's a protocol layer token that's creating a network, And the value of that token is your prediction about the future adoption rate of that network. And then there are protocol layer tokens, which are all about whether that protocol is doing anything useful, right? Expedia is valuable if people are using it to book trips. It's not very valuable. It's really hard to book trips. And that's what gives the application layer tokens value. So before I close this out, Paige, let's just go back to the prior slide. And I want to give you a few examples. So I've given you the concept. There's layer 1 tokens and there are layer 2 protocol or application tokens. Let's just go through a few examples though, so you understand what some of these are really trying to do, okay? So here, I just go through a few popular ones. You may have heard of some of these. The first is Bitcoin. People in the crypto community refer to Bitcoin as digital gold because it's thought of as the most robust long-term store of value. And the reason they call it digital gold is it has something that's really in common with gold, which is it's scarce. Now, gold is scarce for a couple of reasons. I mean, one is there's not that much of it on planet Earth, and two is it's super expensive to dig up out of the ground, and three is it's really, really hard to move around. So generally speaking, there's not a lot more gold being produced in the world, and so it's thought of as relatively price stable, especially when fiat currency is being, inflated as it is today. Bitcoin is just like that in that it's scarce, but it's not because it's scarce buried deep in the ground. It's scarce because the Bitcoin software limits the number of Bitcoin tokens that will ever exist in the world. And so as computers compete to validate transactions, it takes more and more power and more time to find these Bitcoins because there will only ever be 21 million Bitcoins in the history of the universe. So gold is naturally rationed, Bitcoin is algorithmically rationed, but it's the rationing function that gives it value. It's its scarcity, and that's why people call it digital gold. But there are other cool things going on in crypto that have nothing to do with Bitcoin at all, right? So I'll just go through a few of them. There's a token called USDC. USDC is a payment token. It's what we call a stable coin, which is that it's always worth $1, and that's because it's redeemable for $1 from the issuer. The issuer has dollars sitting in a bank account waiting for you to claim it. So if you think about traveler's checks or prepaid cards as other things like this that you've used to pay bills in the last 30 or 40 years, USDC is just the most recent iteration of that. It's a way of me emailing you money without the need for there to be any underlying bank. I can send you cash direct to you without the involvement of any bank or any bank account. And I can do it over the internet instantaneously. One of the advantages here is that unlike other means of sending cash, there's no settlement time. So, if I try to send you money over the automated clearinghouse system, it may take 3 days for you to be able to access it in your bank account. Even if I send you a wire transfer, it could take hours before you see that in the bank account. But with USDC, it shows up as fast as a text message shows up. It's instantly there and it's instantly settled and it cannot be called back. So that's another token. I have the ETH token here, the Ether token, which powers the Ethereum blockchain. ETH is all about creating an ecosystem for decentralized finance apps. It powers a network that's about smart contracts, which allows the network to do a lot of the functions that like a mortgage lender might do or a payment processor might do, only it does it by algorithm versus by a written contract that somebody has to interpret. And a lot of applications are built on top of the Ethereum blockchain for that reason. There are lending platforms like Maker where you can buy this token and it's a way of people exchanging money at interest across the internet. You lend money in a native crypto token and you receive more of that crypto token back in interest. Compound is a similar project. Just going to the right side, I'm going through this a little bit quickly. There's a token called Zcash, whose whole purpose is to allow you to engage in privacy shielded transactions. So if you're worried that the Bitcoin blockchain is searchable, which it is, Zcash is not searchable. That's a way that you can send money. For example, if you live in Venezuela and you wanted to contribute to the Guaido, opposition regime, and you don't want to go to jail, you're going to send that money in Zcash so the bad guys can't see what you're doing. Or, if you're trying to do a transaction, the existence of which might move markets or result in some dislocation publicly, you might use Zcash for that because it's privacy protected. I want to be clear, not all crypto tokens are about financial services though. So again, the internet analogy is very apt. Not everything that sits on the internet is about finance. Some of it's about air travel. Some of it's about information exchange. Some of it's about other things. So the example I give on this is Filecoin, which is a really interesting project launched a few years ago to create decentralized cloud storage to compete with AWS and Microsoft in the cloud business. Those of you who are HBO fans will remember that in season 8 of Silicon Valley, Richard, the main character, has this idea of building a new internet. And this was what he was talking about, actually. The Filecoin guys were advisors to that season. The concept there was there's a whole lot of unused storage space on this computer's hard drive, on my cell phone, on Brian's desktop computer, and every place else. That unused storage space has value if you could connect it, right? The value is, hey, I could rent storage space and maybe it's cheaper than using Amazon's AWS servers. Why don't we find an incentive for people to allocate a little piece of their hard drives and make money doing so? And the way it works is you download the software ring fences a little piece of your hard drive for storage used by others, and you receive a Filecoin in compensation for that. Kind of a cool idea. But what you're getting out of this, I hope, is the idea that all of crypto is about finding value in decentralization. It could be decentralized cloud storage, it could be decentralized lending, it could be decentralized saving, or a lot of other things. But the main point is there are things that used to be done expensively by big centralized managers called banks. And it turns out that with technology, we can do all of those things basically for free using decentralization. That's what it's all about. So Brian, let me turn it back to you, but that's kind of my quick cook's tour of what are we doing here and why do these tokens have value?
That makes sense. And I'm glad you brought up Silicon Valley at the end, because when you're talking through this, I just kept on replaying the new internet in my mind from season 8. But I think that sets a great framework for the broader use case, the broader value related to crypto. I think an area that we get a lot of questions about, and even some of the pre-registration questions today, is on the volatility, quite frankly. So I think, transitioning from the broader appeal of crypto, can you kind of hit on the volatility and how retail investors in particular can understand it? Should they be concerned about it? How do they really kind of balance that out?
Yeah, so it's interesting. When I obviously get this question a lot, and my first reaction when I hear about the volatility question is, volatile relative to what? So, the price of Bitcoin is obviously volatile relative to cash and relative to the S&P 500. I mean, that's true. On the other hand, it's a lot less volatile than certain kinds of options and certain kinds of derivatives products that people buy every day. And it's way less volatile than certain segments of the small cap stock market, generally speaking. I mean, there are days when Bitcoin might move 20%, but on most days, Bitcoin moves, 2 or 3% one direction or the other. And it moves less and less as adoption gets higher, right? So as with any asset, the more illiquid it is, the more it's subject to rapid price swings. The way I think about it is, you're experiencing a little bit of volatility caused by the early days phenomenon. So if you think about internet stocks in the late 90s, people were super excited about the internet. They didn't really know what it was, but they knew it was really buzzy. And so you had all kinds of stocks that were going from zero to the moon in a very short amount of time. Remember that era, 98, 99, people were paper millionaires. I remember being at a wedding once with the CEO of barbecue.com. There were these crazy ideas. And many of those companies went bankrupt, and the volatility indicated a confusion on the part of investors about whether those companies had value or didn't. But some companies that came out of that era had enduring value, and that was the era when Google and Amazon were created. So what's going on here, and this is the way you ought to think about risk in this space, is you have to have a thesis for why this particular crypto token is the one that's going to have value. If again, putting in historical context, how do you know if this token is Alta Vista or Mosaic or Netscape or Google, right? Really, really smart people actually could figure that out, and they could figure out why Google was ultimately going to win, but your average person had a hard time doing that. And so what I always tell investor groups is you don't want to make a selection of a particular crypto asset without knowing what it is. And you don't want to do the really dumbest thing that a lot of people do, which is say, well, I'm going to buy Filecoin because it's cheaper than Bitcoin. That's a little bit like saying, I'm going to buy this small apartment development investment because it's cheaper than Apple Computer. I mean, they have nothing to do with each other. That's a silly way to make investments. But if you understand what you're buying, which is I'm buying a payment network, or I'm buying a decentralized cloud application, or I'm buying real-time payments, suddenly it starts to make sense. So think about it mentally the same way you think about stocks. And within that category, you may find that the volatility is your friend. Right? You may find that it's an opportunity to get in very, very early on something that you have a thesis for growth about, but you should have that thesis before you start buying.
That makes sense. And I think it's, what you mentioned about the price is very similar to conversations we had honestly, before fractional shares related to stocks became much more prevalent, where we saw that people would want to buy something because it was $8 a share or $12 a share, whatever it may be. And fortunately, I mean, at least my side of things, we've seen that decrease because of fractional shares and, similar with crypto. So that's interesting. I think, next to volatility, the next area we get probably the most questions about, and we actually got a few coming in from the Q&A, I think, with the recent news from the SEC Chair Gensler, I think related to the regulatory environment of crypto. And, I'd love to get your thoughts on how do we come up with, a smart or an ideal regulatory environment in the US for crypto, and what are the risks of that for investors or crypto in general?
Yeah, well, so you've got a couple of problems when it comes to the US regulatory environment, some of which can be solved and some of which probably won't be solved. The one that won't be solved is the fact that unlike in other countries in the developed world, we don't have a unified financial regulatory system. So in this country, we have multiple financial regulators that are all vying for turf. So, you have the OCC, my former agency that regulates the banking system. You have the Federal Reserve, which regulates the payment system. You have the SEC, which regulates securities, but then you have the CFTC, which regulates commodities and derivatives. And then you have, dot, dot, dot. So part of the problem is, as crypto grows in importance, every agency wants a piece of the action. And so they issue overlapping and sometimes contradictory guidance on what's going on. That's an inherent problem of our system. There are historical reasons why we have that system, and some of it might be a strength. Maybe there's some competition going on among the regulators, but it's got to be very hard to have clarity on those things. So I come back to a regulation is about risks. And if we think about what the risks and uses of these crypto tokens are, it becomes a little bit easier to understand what the regulation could do to your future investment, right? So I mentioned, I'm just going to go through a couple of tokens and describe the regulatory issues with each to give you a flavor of how this works. So I mentioned the USDC token a minute ago, which is one of these big stable coins. It's a payments instrument. USDC is most likely to be affected by banking regulation. And the value, will go up if the banking regulators allow banks, as I did, to use USDC for payment transmission the same way that they can use things like the ACH network or the FedWire system to send money. If they refuse that authority, however, the utility of USDC will be lower and the value will be lower. Same thing with some of these other tokens that may be investment type products. So if you take a token like Uniswap, which is a decentralized exchange platform, if the SEC says you can't be a decentralized exchange, if you're an exchange, you have to be a centralized exchange. You have to have a board of directors and a management team and everything. Well, that would tend to be bad for Uniswap and bad generally for people to avoid the fees that are associated with dealing with broker dealers. On the other hand, if the SEC said, hey, sure, even though Uniswap is a technology rather than a company, we're going to go ahead and authorize it to be a broker. And then now there's a legal framework around it, and thus people can feel safe dealing with it. That's going to create all kinds of value for the Uniswap token. So, the adoption or rejection of it by the regulator has a lot to do with its price. And then there's the underlying issue, and this is what investors really ought to be thinking about. There's the underlying issue of, in a real decentralized token, like Bitcoin, for example, you can't get the kind of disclosures you would normally get if you're buying like a stock or a bond, because there is no issuer of that stock. So think about for a moment what kind of disclosure you get if you buy a share of IBM. You get a copy of their 10K or their prospectus, and the 10K says, hey, here's who the management team is, and here's what their strategy is, and here's the disclosure of what they've got in the bank, and here's the compensation of their board members, and here's their oversight, here are their regulatory and legal risks, et cetera. You're getting all those disclosures because there's a group of people out there whose efforts you're relying on to create value in the stock. And if those people are fraudsters or if they're just not very good, then the value is going to go away. So you're entitled to those disclosures. With Bitcoin and with all the decentralized tokens, there's no management team. There's no company to get a disclosure from, right? Remember, it's just you and me downloading software and connecting our computers. That's all it is. And so, again, you can't rely on the disclosure regime for investor protection. You have to instead have a thesis that what this network's about is X, and you can read the white paper of the original software developers to understand what they had in mind. But first, you need to play around with it and go online and actually look at it and feel it and see how fast it is compared to your bank before you decide you want to invest in that product. But the lack of disclosures is, both a feature and a bug in crypto.
Gotcha. So there's a couple questions on that, and I think that goes nicely into kind of thinking about it, because you mentioned you're looking at specific, stocks. You have the regulatory filings, you have, all those different accounting statements, things like that to look at. What are some other things outside of what you just mentioned for investors to, I guess, do due diligence on different crypto tokens to make sure they're protecting themselves and making informed decisions?
Yeah, so there are a couple ways of doing that. So first of all, the major exchanges, including Binance US and a couple of others, have pages on their apps and on their websites that provide you descriptions of what the tokens are. We don't represent value. We have no idea what the value is. We're just a marketplace where people buy and sell. But if you want to know what this is, how does it function? Why are people using it? You can go on our apps or on our websites and you can get some information about that. But I'll tell you actually a more sort of a super cool way of learning about these tokens, which is one feature of the crypto universe is the concept that you can earn crypto as well as buying crypto. And what that means is, again, at a number of major exchanges, including ours, there are tabs you can go to inside of the app where if you're willing to watch an 8-minute video and answer 3 or 4 questions about what this token is about, you might be able to earn a handful of those tokens just by going and learning about them. And so that's a great way to then get some tokens for free that you can experiment with, you can send to your friends, you can hold them for a few weeks and see if they go up or down in value. But the earn campaign is something you don't really see any other place. I can't read about Apple Computer and then receive a share of their stock, but I can go and read about Solana and then get some Solana tokens in compensation.
Interesting. That's great. So I guess before we hop in, we got some great questions coming in from the audience. Before we transition there, I think, I'd love to just get your thoughts on the future outlook of crypto and some particular areas that you're excited about and you're intrigued with most.
That's great. Well, in terms of the future outlook, let me just say, I think that we are sort of where Uber and Lyft were halfway through their adoption cycle. And here's what I mean by that. There was a time when the idea of getting in the back of a stranger's car was such a crazy idea, nobody would ever possibly do it. Then these things launched sort of in stealth, and suddenly everybody had it. I don't know if you remember that day, but I remember when I realized I was the last person in America who didn't have Uber. And that was probably 5 years ago, but I realized I didn't. I was still hailing taxis. And I tried it once and I realized, I was never going to go back. That was crazy. It was so much easier and better. Right at the time that started happening and the mass adoption started occurring, that's when government got involved and did everything they could to kill it. So if you remember that point, every airport authority in America tried to ban Ubers from the airport. And they said it was unsafe. They said that they weren't licensed, et cetera. And then every taxi cab commission in America got into the action too. And they tried to say, well, the taxi drivers had bought these medallions and it's not fair that they paid the city $1 million for the right to drive a cab. And you're just some guy driving your Camry. That's just not fair competition. And they made all these arguments to try and bring it down, but they were too late. There were already 50 million American Uber users, and that's too many. That's too many voters for people to actually kill something that people want that strongly. So I think that's where we're at right now in the crypto life cycle. We're now at a point where most surveys show between 50 and 60 million Americans hold crypto of some form. And the market cap of crypto over the last 6 months has bounced between $1.5 and $2.25 trillion. There's never been an activity with that level of market cap that has gone away. So we're now going to go through a couple-year period of uncertainty where the regulators are going to see if they can kill this or at least rein it in relative to the bank-dominated system. And what's interesting is, although both political parties have had some problems with crypto, at the moment it seems to be the Democrats that are loudest in their opposition. You probably have seen Senator Warren's statements just over the last handful of days. Not a partisan issue, but lately, just because they're the party in charge, you hear more from them than from the other side. And I do think it's a little bit puzzling, since crypto is the best counterweight to banks. And generally speaking, Democrats have been hostile to banks. So my message to everybody who will listen is, if you're skeptical of the current system, if you think that banks don't treat you well or treat you impersonally, or if banks have all the power and you have none, then crypto is your friend. Crypto was built to decentralize banks the same way that, the internet decentralized the post office. That's really the message. But how we do and whether we survive and whether we continue to grow will depend on us having an Uber-like outcome as opposed to something else.
Perfect. All right. So let's transition to some questions. We got some good ones. I guess the first one, this is something that I think we got a ton of questions on this, I don't know, a couple months ago. Are the environmental concerns on mining legitimate? If so, what are some things being done or you see happening to mitigate those environmental concerns that really kind of came to the forefront?
Yeah. So the answer is, sort of it is and it isn't. And what I mean by that is, I mean, obviously we live in a time where climate change is front of many people's minds. And so any incremental contribution to carbon emissions is something that we need to take seriously. I'll begin by saying that. But again, I sort of think to myself, okay, so energy usage compared to what? So people talk about crypto uses X gigawatts, and that's equivalent to this or that or the other. And it's a lot of gigawatts. Bitcoin in particular is very energy intensive. However, JP Morgan uses a lot more energy than Bitcoin does. Nobody ever thinks about that. And all of the energy being devoted to Bitcoin is energy that isn't being used in the banking system because by definition, crypto is an alternative to the banking system. So you have to start with what's your baseline, and the current level of risk isn't the safe level of risk. It's just the current level of risk. And so it's possible that the energy usage of Bitcoin is diverting away from something that was even more energy intensive. So start with that. Second, for the longest time, up until this most recent Chinese attack on crypto, the majority of Bitcoin mining was being done in China. And the reason wasn't because China was such a pro-crypto company. The reason was China has an enormous amount of hydropower, right? And crypto is seeking, Bitcoin in particular, is seeking the cheapest source of power. So globally, that would be hydropower in places like China and geothermal power in places like Iceland. So if you think about it, if a lot of the energy being used by Bitcoin is fully renewable, clean energy, then who cares how much it's using? The point is it's using clean energy, and that's not really relevant to the discussion, but you don't usually hear that discussed. There is, though, a real situation, especially in the United States, where some of the cheapest forms of energy here are like coal. And clearly there are examples of Bitcoin miners reopening old coal mines and old coal-fired power plants as their source of energy. And that's, an incremental contribution to emissions and ultimately climate change, which is a problem. There is, however, and this is the really interesting story, so maybe it's a long windup for this short pitch. There's a really interesting movement out there called Bitcoin as battery that I just want to describe for a second, because this is one of the coolest ideas going on in crypto. The notion is this, that in the United States, we don't actually have that much hydropower, but what we do have is a lot of solar and wind. What we don't have, however, is enough investment in solar and wind capacity. And the reason is this. The reason is on a really hot summer day in Palm Springs, where there's a lot of solar farms, during the day, those solar farms generate more electricity that can be used. And at night, we don't have good enough battery technology to store it. So there's a power deficit at night. What that means is there's not a lot of incentive other than government subsidies to build more solar, because they can't sell what they're producing and they can't store the excess overnight and sell it at night. So it's not really a profitable business. That's why solar is so expensive. It has to be subsidized. The Bitcoin as battery movement says what we need to do is locate Bitcoin miners in those places to suck up the excess capacity during the day. If you could pay for the excess capacity of solar or wind during the day, that would create a profit model that would incent solar developers to build more solar farms. And that would be a good thing. So it is possible that Bitcoin can be part of the solution here. And I know that there are power grid operators and others that are looking at ways of inducing Bitcoin miners and other crypto miners into those localities. So it's kind of an interesting development.
That is extremely interesting. I hadn't heard that. So no, that's great. Okay, next question. Can you touch a little bit more on interest earning crypto tokens or platforms like BlockFi or we'll just leave that. And do you think the rates they're offering are sustainable? What are the risks that investors should be considering when they're looking at this?
Yeah, so I'll explain what's going on that allows them to deliver those kinds of returns, but think about it for a moment like the performance analogy would be like money market funds, right? Where at least prior to the financial crisis, and I mean, some people on the call don't even remember prior to the financial crisis, but just by way of example, time was you could earn in a money market fund 5-6% annually on your money fund at a time when the bank might have been offering 1.5 or 2%. I know both of those numbers seem fantastical today when banks are offering basically zero. But in the real world, when money funds were real investment managers and they were doing, bond investments and they had a whole variety of strategies, you could earn way more interest in a money fund than you could in the bank. And that was because there was underlying investment activity going on. So even though people didn't perceive risk, there was risk, right? Money market funds weren't insured by the FDIC. It was possible they could fail. And indeed, going into the financial crisis, one or two of them did fail. They broke the buck, which is sort of a breaking of the social contract that says every share will always be worth $1. They had returns that failed on that. So there's risk in that. Same thing in some of these platforms that are offering decentralized services, like the one that you mentioned. What's going on is they are managing in the back end away from you a Bitcoin portfolio through one or more asset managers, and they're generating rates of return that they're then sharing with you in the form of what looks like interest. It's not technically interest, but they're sharing with you those investment returns, much like a money market fund would do. As with a money fund, there's risk, right? If they fail to properly manage the collateral, if there were a flash crash that resulted in the underlying Bitcoin going to zero or whatever, you could experience a loss of principal. Or you could experience, decline in interest rates over time as volatility goes down. So none of that stuff is guaranteed. But on the other hand, thus far, money hasn't been lost on those platforms. So, my watchword, and again, as Brian said, we're not here to give financial advice, but the wisdom of the ages, not specific investment advice, is you always want to be diversified. You want to engage in asset allocation. You want to have a risk tolerance and manage to that. A lot of people feel like, hey, I want most of my money to be in an FDIC insured account, but I may have a small amount that I can allocate to high yield because that changes my overall profile. That's not a crazy idea.
Yeah, and I think that's interesting because that aligns, closely to, as we're talking on related to crypto, not only diversification, but having, let's say, a crypto aspect to your portfolio, because historically it has been uncorrelated with traditional investments, but then also diversification within a crypto sleeve and considering that. So I guess next question, one that's come up a couple different times in different ways. I guess can you hit on the considerations, pros and cons of exchanges custodying crypto versus, let's say, a wallet type of approach, as investors are kind of looking at both those options?
Yeah, well, so a couple thoughts. I mean, first of all, exchanges are the way most people encounter crypto for the first time because it's easier. I mean, you can come onto Binance US or one of our major competitors, and with one or two clicks of a button, you can buy Bitcoin and have it. And the private key that represents the Bitcoin sits in a wallet that exchange manages for you. So that's an experience that's going to be most familiar to people who are new at this and are a little scared that if they try to, either Bitcoin mine or go to a Bitcoin ATM or somehow buy it, in some other fashion. Well, what happens if they lose the ATM receipt, or what happens if their hardware wallet gets demagnetized or lost, So that's an issue. The more sophisticated people start to take different approaches to this and decide that they want to have some of it outside of the exchange because they remember stories like Mt. Gox, where the exchange blew up and the crypto was all lost, or, the famous story of the Canadian crypto CEO who either did or didn't die. The body was never recovered, right? And so who knows what happened there? So the more sophisticated people start to think about, gee, maybe I can manage my own hardware wallets, or at least I can diversify the way that that's stored. What I would tell you is, the modern exchanges have developed very, very sophisticated ways of custodying crypto in ways that are super safe. And an insurance market has also developed where a couple of exchanges do have insurance against loss. It's not government insurance, but it is insurance designed to bear against some level of loss. So the risk of using exchanges is lower than it was, 5 years ago for sure. And having worked at two of the biggest ones, I have a pretty good sense of that. The thing to think about with exchanges, just like when you're investing your equity portfolio, has a lot to do with fees. right? So remember that as with mutual funds or whatever, a lot of your long-term investment has to do with how low you can keep the fees. You can juice your long-term returns 20% just by making sure that your fees are 20 bips lower at your one platform than at another. And it's true in crypto too. There's a wide variation in how expensive it is to trade. My exchange is one of the least expensive exchanges to trade on because our view is it's your money. We shouldn't be charging you for access to it. Other exchanges have a different philosophy about that, but those are the factors I would think about.
Perfect. Next question we will hit on. I guess it'll combine a couple of the questions related to really the pricing factors of crypto. I guess how should retail investors think about and consider how crypto is priced, considering that there can be substantial fluctuations on tweets or things like that that are kind of completely outside of their control, and what would you say that they should be thinking about?
Yeah. So look, I mean, one theory I have is that it's like I said before about the kind of baseline and status quo biases. We treat crypto as uniquely risky in that way because it's new, and we ignore the fact that one surprise earnings report and pick your stock declines 20% in a day. That happens every single day. Some company misses earnings, or some company reveals a scandal, or they reveal a government investigation, and that individual stock drops 20%. Now, the market doesn't drop 20%, but that stock does. And again, if you think about crypto tokens as there's specific assets that are relating to an actual activity, this is not magic internet money, okay? Crypto usually drops for the same reason any stock drops, which is a whole bunch of people sold it. More sellers than buyers showed up one day. Price is going to drop. That'll happen if Elon Musk says, I've decided to sell all my Bitcoin holdings. Well, damn, that's going to cause the price to fall. But if Elon Musk said, I'm going to sell all of my Tesla stock would fall too. So it's not unique to this asset class. It's more of an issue of understanding that it's a relatively new market with relatively, relative to the stock market, thin capitalization. And so it takes less to move prices right now than it would in a high price discovery environment like the US equity market. But don't fetishize these price movements. They're not that different from individual stocks, especially growth stocks and startup stocks, right? Think about it like that, and I think you'll get a comfort level that's different.
Perfect. Next question. There's a couple questions related to I guess more of a government created cryptocurrency, and interested to get your thoughts on how you would see that impacting the broader market, and if that may be the case in the not too distant future.
Yeah, well, so what you're referring to, or what the questioner is referring to, is something called central bank digital currency, which is kind of an idea that's sweeping the world right now. China is the first country to actually deploy a central bank digital currency, and it's now actually in use. And the Federal Reserve System in the U.S. has been talking about this for a couple of years at this point. What I would say is there are pros and cons of central bank digital currencies. A pro is it would be a faster way of settling transactions, and the U.S. is very late to the party on real-time settlements. So something that makes trading happen faster and that eliminates the uncertainty of when are you going to get your money and everything, that's to the good. The thing that's a little bit scary about it is that when governments create those kinds of networks, what is going to go away eventually is cash. So the trade-off with central bank digital currencies is privacy. Now all payments flow through the Federal Reserve, which means they can see every transaction you're engaged in. And you may or may not want them to see every transaction you're engaged in for reasons that might not even be obvious. I mean, you might, for example, live in a district, a congressional district, where you want to make a campaign contribution to a candidate that might even be the winning candidate, but is not the favorite of the New York Times. And you may not want the Federal Reserve saying, hey, that person, voted on the wrong side of some important issue, so we're not going to process that payment, for instance. Or you might want to buy cigarettes, and in a future regime, we're very health conscious these days. The Fed may say, no, as a way of getting people healthier and eliminating lung cancer deaths, we're not going to process payments for cigarettes anymore. I mean, these things could all happen. It seems fantastical, but in China, where they've built this, that's exactly what they're doing, right? they've actually stated in a speech by the vice chairman of the People's Bank of China that one of the purposes of a central bank digital currency is to allow the government to decide which transactions to approve and which to deny. Many people will say, well, that's China. That's an authoritarian system. That wouldn't happen in the United States. But my counter to that is, one of the reasons we're not an authoritarian system is because we don't have the tools to be an authoritarian system. We purposely built a system that makes that harder. But once we start adopting the tools that would allow that to occur, it seems inevitable to me that at some point in the future it will occur. And so to me, it's better not to have that. But so it's an important open debate. I will say the alternative to central bank digital currencies is stablecoins, which I described before. They're a privately issued yet instantly settling form of fiat currency that allows you to have all of the advantages of a digital currency at the central bank level without the involvement of the central bank. And that, I think, is the future. The scaling rate of stablecoins, Brian, has been insane over the last 18 months. The two largest stablecoins are up something like 2,800% in barely over a year. Hard to find another asset class where the adoption rate has gone up that fast.
Perfect. And last question, it'll be a two-parter before we wrap up. There was a couple of people asking about, where to find more information about the Bitcoin battery concept. Found it super interesting. And then there's other questions about just, resources, whether it be books to read or things like that to become more educated about this topic. Any thoughts on that?
Yeah, for sure. Well, so look, on Bitcoin as battery, you can literally Google Bitcoin as battery and you'll get a series of papers and news articles on that. There are a handful of reporters in the crypto press, like at CoinDesk, for example, who write on the subject pretty regularly. There's a very smart guy named Nick Carter, Nick without a K, that has written a number of really interesting analyses on that. So that's easily Googleable. In terms of books and things to read, I'm just going to go ahead and shill for a particular book that really was the thing that caused me to understand this and have a light bulb flip on, which led me down this path. Okay. So there's a book by co-authors named Michael Casey and Paul Vigna. Michael Casey, I believe, is an MIT professor, and Paul Vigna is a Wall Street Journal reporter. And it's called The Age of Cryptocurrency. This book came out, I want to say, in 2016 or 17, something like that. But it is the best layperson's introduction to both the history of Bitcoin and the power of blockchain generally, the power of networks in finance. They wrote a follow-up book called The Truth Machine, which kind of elaborates on some of those things. But if you read nothing else on crypto, you should read those two books, and you'll understand what you need to know.
Perfect. As you can tell by my background, I always love good book recommendations. So I guess before we close out, want to just remind everyone, if you want to learn more about crypto, because there's questions on that, you could visit the SoFi Crypto Guide page just through the link in the chat. Also, you can explore crypto in the SoFi app or online. I guess, Brian, thank you so much for joining us today. This was extremely informative. I have to tell you, I read about crypto. I follow it just because of, my occupation. I even watched a documentary, I want to say last week, thinking about it. And I learned more talking to you than I have, watching the documentary or, reading about it randomly throughout the last year or so. So I really appreciate it.
I'm so glad. It was all my pleasure. And what a great audience to have. Thanks for having me.
Perfect. All right, everyone, have a great rest of the evening and a great weekend.